Good afternoon, and thanks for joining us. I'm Amy Pendergrass with Mock Adams, and I'm going to get us started for today's session, Higher Education Virtual Town Hall. The presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key.
Now I'd like to turn it over to Melissa Harmon, Moss Adams Partner and Higher Education National Practice Leader. Melissa?
Thank you, Amy. I'd like to thank all of you for being here today and going through our higher education town hall. There's so much going on in the current environment, and we wanted to take the opportunity to get in front of you and go through some of the questions that you've already submitted and those that you may ask today. So we know they're really pressing, and with the release of the American Rescue Plan, we're wanting to get in front of it with you. My esteemed colleagues today that'll be presenting or answering questions as the panel include Laura Roos, she's an assurance partner, Tammy Erickson, also an assurance partner, and Matt Parsons, an assurance partner. Joining them and part of our federal team is Art No. He's an assurance senior manager, as well as Matt Densdale, an assurance senior manager. And then Lauren Haverlock is our tax senior manager that's going to go through the tax questions as it relates to what's pressing in higher education. Their contact information and bios is included in the webcast console if you'd like more information. Like I said, we've received several questions already in advance, as well as some that we know our clients and some of our prospects have been asking. We will do our best to get through what we can today. If we don't, we will absolutely follow up with you. Please make sure you are using the Q&A function to submit your questions. With that, I'd like to get us started and go through the session with you. And the first question I'm going to ask is going to go to Lauren related to our 1098Ts. So the question has come up is, are the higher education emergency relief funds required to be reported on a 1098T?
That is a great question. The second round of HEERF fundings, I guess I can call them HEERF 2, these are not necessary. These are different. They're not taxable, same as the HEERF 1 funding, so not taxable to students because it's considered disaster relief payments. However, there is one major change that's come out through one of the IRS's notices. They issued a notice 2021-6, and that notice stated that while 1099 filings aren't required, 1099 MISC filings aren't required, since the funding isn't taxable to students, what is required and is as of today is that the funds that are given to students that are used for tuition and other types of expenses related to their education are required to be reported on a 1098T. Now, this is a departure from what had been in the past, what had been the advice that had been given out as of December of 2020 related to the first round of HEERF funds. Those were explicitly in an IRS frequently asked question accepted from both 1099 reporting and 1098T reporting. However, in this new notice in 2021, the IRS says, no, this should be included in 1098-T reporting. So this has created a little bit of confusion. And as of right now, we know that NACUBO has asked for clarification and highlighted that this is a little bit inconsistent, and organizations have created reporting, their reporting in their systems internally to exclude these from 1098-T reporting. So this is a departure from what organizations have done to prepare prior. So that's where we're at right now with that. Of course, things can change. And as of everything related to COVID-19 funding, we expect changes to happen. So it's just a matter of when and how much warning we all get.
And just to be clear, not taxable at this point?
No, not taxable. And it's clear that they're not going to be taxable to students. So the funding that is given to students is not taxable to them as taxable income. However, the flip side of that is that the students cannot take deductions for the costs on their personal tax return. So that would be a tuition and fee deduction, American Opportunity Credit, Lifetime Learning Credit, those types of credits associated with expenses that they paid with the funding that they received from HEERF 1 and HEERF 2. So it seems like this adjustment to the 1098-T reporting is to help alleviate that, but it actually is creating a little bit of confusion for organizations.
Perfect. Wonderful. Thank you very much, Lauren, for the tax updates on that. And we'll come back to you for a little bit of PPP goodness here in a minute. But staying on higher education emergency relief funds, I'm going to go, Matt Parsons, to you next. And I think you could walk us through, I'll call it, well, for the sake of this discussion, HEERF 1, 2, and 3, generally the allowability and usage of these funds. If you can just do a quick overview of what can we use these on?
Great question. Yeah, and I'm going to assume that this question is more targeted to the allowable costs of the institutional portion of funds. And thankfully, on March 19th, the Department of Ed actually just recently published an update to their frequently asked questions and gave us some more insight on what we can use these funds on. Unfortunately, I think they provided more information on what we can't use it on. So, for example, marketing, recruitment, it can't go into your endowment. You can't use it for capital outlays or to pay executive salaries and bonuses, et cetera. But when things we do know it can be spent on is to defray expenses associated with the coronavirus. I think the one topic that's been on everyone's mind is lost revenue. There's been a lot of discussion of what that is and how do you calculate it. And I think we're going to get into that topic a little bit more later on in today's session. But some other expenses that are allowable are technology costs associated with the transition to distance education, faculty and staff trainings. We all know there was a lot of discussions and planning around how are we going to transition to remote learning. I think the most confusing element is the Department of Ed clarified payroll costs, and so what exactly that means and what payroll can be allocated, I think are very, very specific to your organization, and definitely want to talk to your own advisors over what those could be. For example, I know we've had a lot of conversations over, can we provide stipends for internet usage to faculty working from home? And I think it depends, if there's a need and there's documentation supporting, again, why that was necessary to transition to remote learning or distance learning, then there could be a cost for that as well. And then, of course, making additional financial aid grants to students is, of course, what the Department of Ed is always hoping our schools are providing to use their institutional funds on. One other element I wanted to clarify is that, indirect costs we have learned are now eligible to be applied to these grants, whether you have an indirect rate plan already or you use the 10% de minimis. So definitely think about, how you can incorporate those costs and capture them as long as they're reasonable is very key. And then my last suggestion would be, since we received clarification that these costs can be applied back to March 13th, I definitely recommend you revisit any expenses that may not have been covered by maybe the HEERF 1, HEERF 2 allocations. For example, I know many schools applied room and board refunds when using up their institutional funds, and so they didn't even have to really contemplate what other costs they incurred back then. So I definitely think going back, looking at what those costs were to transition to remote learning and distance education are key, and carrying this forward so that you can apply these to your current costs.
Perfect. Anything in the American Rescue Plan that's different from the other two that you'd like to highlight, or, pretty consistent?
Yeah, so I think, the original HEERF funding was really targeted on costs associated with delivery of instruction. And we know under the American Rescue Plan, as well as the CRRSAA Act, that really it's for flexibility. There's more flexibility to again use for those staff trainings. We saw a lot of different devices used for even in-class cameras, for example, for different technology sources that were needed to be able to deliver instruction either with the social distancing guidelines. So really just taking a hard look at what those additional costs were that you needed for your instruction are now applicable.
Okay, perfect. Thanks, Matt. We did get a question, and this maybe it depends, but I'll figure I'll ask it. So, I think there's a couple questions related to, I stopped paying certain people, or I stopped contributing to a 403B or a benefit plan, certain cost reduction measures, right, that were due to the pandemic. And now reinstating some of the back pay or back benefits, any thoughts on that? It depends, and get with your advisor on that, but do you know offhand?
Yeah, I think it definitely does depend. There was clarification in the most recent FAQ saying that, really these are not meant to cover additional expenses that you would have taken on as a result of the pandemic. But if there are, again, defrayed expenses that you would normally have paid in a traditional course of business that you've either put off, to really look at those costs as well and think about the guidance, and potentially those would apply.
I agree. And just to be clear, when we're talking about classroom or return to campus and even online, right, costs and some of that transition is applicable as well.
Exactly.
Okay. All right. Perfect. That's great. And I know that we're going to have more questions on that coming up, but that was good clarity on that. As it relates to, I'm getting ready for my audit, right? Now I've hit the 750 and I know I'm going to have auditors come in this year. Well, what advice would you give to the folks on this call in getting ready for their first higher education emergency relief fund audit? Or maybe, they're still going through one right now as we speak. How do you get ready, and what are we looking for as auditors?
Yeah, I think when we went through this first round of audits this year, it was key that everyone was scrambling at first. Everyone was trying to adapt to social distancing and working remotely. And so we saw in many cases the traditional support for example, like reviews and approvals of expenses wasn't there. And maybe it's because they didn't expect federal funding to come into play later on that would help cover those expenses. So once you've identified what those costs are, I just make sure that you've gone back and looked at what the support is you have on hand, so that when an auditor comes knocking and might potentially make that selection, that you're able to already have some kind of thought process and why you felt it met the standards for allowability, and that you also have the evidence that you need for multiple layers of review, I think, and approval. Of course, the reporting element is a big piece of the audit standard, and we know there's so much information that the Department of Education wants made public and available to both students and other users. And so making sure that you have the detail that supports what reporting has been made. And I know that's always evolving. So, we're looking at periods of time. So thinking about what costs went into that one reporting element. If you don't have a way to capture what's been reported in past quarters, that you maybe take a screenshot or some kind of evidence to prove that it was made timely and reported in accordance with the guidelines set by the Department of Ed.
Great. I'm sorry, I've got some follow-ups that are coming in on the Q&A, but it's relevant and they're quick. So the reporting requirements under each of the different laws for the higher education emergency relief funds, similar, different in terms of the timing, quarterly, monthly?
Yeah, I maybe Art, you would have a better answer. I know you recently wrote a response that would be good here, but as far as my understanding, interpretation of the rules, it's still very consistent going forward as we're getting these additional tranches of funding.
Okay, perfect. And then I think the one thing, while we're there on kind of the allowability that was a little bit different, I think there was some guidance on the student application or basically in this last round related to payments on balances. Do you want to add that in, Matt, on just some clarification on outstanding balances?
Yes. So if those costs are never going to be collected and they're going to be on your books essentially for a period of time because there's no evidence that you're going to be made whole, those potentially could be made as allowable costs as well under the grant, which I think is a nice reprieve for the universities.
Okay, perfect. I'm going to take you off the hot seat now, Matt. Thank you so much. That was great information and truly appreciate it. Art, I'm going to pass over to you on some of the allowable questions, and there's more in this. I think one of the questions, and maybe you can expand a little bit, as it relates to technology. We got a number of questions there, and I see a number coming through in Q&A. Maybe you can elaborate a little bit. Is it, can I use these funds for a new system? Do they have to be for an online platform? Does it have to be tied to the pandemic? Maybe we could talk about the allowability for some of the costs associated with technology and what's allowable and not.
Of course. So I guess first to start off with, I just want to clarify the student portion should be used for the cost attendance and for the emergency cost that is related to the coronavirus. So for the student portion, it shouldn't be used for technology. But for the portion that's related to institutional portion, Matt touched on this, but for the technology costs, the system, we need to make sure that it's associated with the transition to distance learning. So as long as the institution is able to demonstrate that the technology cost is incurred to transition to distance learning, it is an allowable cost, and just got to make sure that it's supported and that there's documentation to support why it would support transition to distance learning.
I think you were a little bit hard to hear, Art, so I'm going to articulate that. So yes, we can't use any of the student portion for technology is what you said. And then I think, on the technology as it relates to the institutional portion, as long as you can demonstrate and document, which seems to be a theme of our responses here, that is somehow tied to either some sort of transition or your return to campus or just living through this pandemic, it likely can be allowable, but you have to go through that determination and match that to the award. Okay.
Correct.
And Art, again, you're a little hard to hear, so we'll try again on this, but lost revenue, that finally we got clarification on lost revenue. And this is, can you talk a little bit about lost revenue?
I'm sorry, hopefully this comes in clear. I'm just holding my mic a little bit closer now.
Better.
So lost revenue refers to the revenues that an institution would otherwise expect, but it was either reduced or eliminated because of the coronavirus. To kind of give some examples, so tuition, which includes enrollment declines, room and board, bookstore revenue, childcare revenue, food service revenues, lease revenues. So those are some examples of revenues that you would typically expect but could forego or be eliminated or reduced because of the coronavirus. Some of the revenue sources that you would not include are alcohol sales, any revenues related to religious worship, marketing, recruiting events, investment income. So just your tuition, like your bookstore revenue, parking revenue, expenses, anything that the college would typically generate would be items that would be included as part of lost revenue.
Perfect. Two quick follow-up questions, and I'll try and answer them. So there was a question on students, the definition of students, specifically, did this last round of HEERF give any clarification to eligibility on the definition of students, and specifically talking about DACA students or some of the international students? My understanding, it was silent again on this and didn't specifically address like the second round. That's correct, right? They added no clarification or did not address this, right?
Yeah, that's correct. They have not. There's nothing in the law that specifies that there has to be eligibility determination, but they haven't specifically come out and said that a DACA student is specifically eligible.
Okay, perfect, excellent. Wonderful. And then I think I'm going to transition over to you, Tammy, to go through some of the implications of lost revenue as it relates to some of our GASB reporters. So one of the questions is, can state budget cuts be considered lost revenue?
Yeah, that's a question that's come up quite a bit. And with the guidance that's out there, we don't see anything that disallows that. So I think the key is, again, documenting how you're coming up with that lost revenue, and also making sure that you're looking at the right period of time. And then also that you're not double dipping with those funds. So if you are getting reimbursed for that lost revenue with a different federal grant, then you want to make sure that you're not claiming it with the HEERF. So great news for, I think, a lot of public institutions with reduced state funds. But again, we're not seeing anything that is not allowing that.
Okay. Perfect. And then along similar lines, this is public and private institutions. Do we get to count lost ticket sales for lost revenue? And does that go into a component of it?
Yes. So lost ticket sales, that's going to be part of your auxiliary services where you can look at that. And so, again, we're not seeing anything that is disallowing that piece. So again, great news, because there were a lot of athletic events that were canceled last year. And so to be able to recognize that lost revenue is huge for a lot of institutions.
Yeah. And I think there was another couple questions that came in that you addressed just by a statement you just said. So auxiliary revenue is part of the consideration for lost revenue, correct?
It is, yeah. So housing, dining services, you just have to look at, they've basically given different ways to calculate that lost revenue. You can use a 3-year average. You can use a year-to-year or a term-to-term comparison. And when you calculate that, so you can look at what way makes the most sense for your institution to do that calculation.
Great. And since we're still on allowable costs, we've got a couple more specific questions came in on this. So any of the three of you can definitely take this, but there was a question about HVAC systems and getting those updated and ready, obviously, for a return to campus. Allowability on that one?
So I think you have to be careful there, because capital renovations are specifically disallowed as part of the use of the funds. So I guess it depends on if you potentially capitalize those costs or not. I guess certain maintenance and repairs that would be necessary specifically to address COVID potentially could be, but I think it's a really hard, very fuzzy line that I would talk to your advisor specifically about before you commit to that expense.
Yeah, and I agree with that. I think you'd really want to document your thought process about it. And again, as Matt said, talk to your accountants about it in advance so that you both agree on your approach that you're taking with that and the documentation behind it.
Yeah. And I'm going to go back to lost revenue. We had a question come in that I think is important. And this did come up on the Nakubo town hall yesterday about your process on lost revenue. And so the way I heard it, the question is, can you have different methodologies in approaching your lost revenue, whether you take a semester or whether you're taking it by particular process? So is it an all-in-one process in determining lost revenue, or can you disaggregate it by either revenue stream or by period or by semester quarter?
I think you'd have to have a reason to use a different approach for different streams. So I think the approach you take has to make sense why you're taking it, not just because you're getting more revenue by doing it one way for one revenue stream and a different way for a different revenue stream. So I think there has to be a valid reason for using a different approach for different revenue streams. That, again, I think you want to document that. I always recommend talking to your auditors in advance so that you don't run into problems come audit time. You can hopefully talk that through and have that documentation in place.
I was just going to add, if your term ends really close to your year end, taking a full year approach might not be your most advantageous, because you have to wait until that year ends before you can really evaluate your modification of revenues year over year. So I think the common trend I've seen most frequently has been looking at semester to semester, and that way you can get in your current spring term by looking at 19 and 20, so that you're not missing out on recognizing those funds in the current year.
Okay, perfect. And Tammy, if I decide that I'm going to use my institutional portion of my funds, to pay for any of the student tuition or cover student tuition and fees, do I have to get the student's approval?
So there's nothing that requires that you get the student's approval if you use institutional funds. So if you're using the student portion, and then you do have to have the student's approval for that. But if you're using the institutions for that, there's nothing that requires it. However, I think you do want to make sure that you are communicating that with the student so that the student isn't later paying that, and in essence, you're double dipping then. So I think you do need to be transparent with that with the student.
Okay, perfect. And I'm gonna get one more, and then I'm gonna switch off into a different topic, but we'll come back with, there's a lot of questions on the allowability on HEERF. And so if we don't get to this question, we will definitely get back to you on some of the questions specifically on this. But, one of the things that came up, and I think it's a really good question, is if I held tuition and I had already planned to, or we took a reduction in tuition for online platforms or did refunds, right, for online platform, is that part of lost revenue?
Yes, I believe it is.
Yes. So yes. So reductions related to pandemic, that switch.
Yeah, because that would be the reduction of revenue related to the pandemic.
Perfect. Excellent. Great. There were so many questions. I'm going to gather some of these questions and probably come back to this at the end. So hold that, my HEERF folks, and we'll definitely get back to that one. Dinsdale, I'm going to move on to a couple of your questions. I guess one of the questions that we had was, are CRRSAA funds report as a continuation of reporting done for CARES, or does it begin a separate reporting process? So in other words, is it all one thing when you're doing reporting, or does it start over? Or how does the reporting work specifically for these funds?
Thanks, Melissa. That's a common question we're seeing, and there was a fact sheet the Department of Education released in January related to HEERF2 and some of those requirements, and based on that and the most recent Federal Register, there actually the Department of Ed actually hasn't established reporting requirements yet. So we don't quite know yet what the reporting looks like for that second tranche of HEERF. I would imagine likely very soon we might hear about that just because of where we are in timing-wise. But as of right now, we do not know specifically what they want in regards to reporting. I would just make sure that you're appropriately documenting what you're spending it on so that you can quickly just transition it over to the expected format of the report.
Okay, perfect. Here's a question that, we've got a couple of these questions as it relates to, and the allowability period. Would one of you be able to, I don't know, Matt or Tammy, address the allowability period on this? And then there was a follow-up question related to the 90-day rule on the drawdown and clarification surrounding that. Do either of you have comments on those?
I think Tammy might be able to take the first one.
Yeah, with the allowability period, my understanding from NACUBO is that there is a 1-year reset with each new grant that's received. So with this latest round of funding, the ARPA funds, once you receive those, then you have 1 year from then for that grant as well as your previous HEERF grant. So HEERF, the ARPA being HEERF 3 now, if you were to get that resets the clock that you still have 1 additional year then for HEERF 1 and 2 as well. And that in some circumstances, you can potentially get an additional 1-year extension. So again, that's what we've heard from NACUBO with that.
Okay. And then, I don't know, Dinsdale or Parsons, any comments on the 90-day period for drawdown?
I think we may have to get back to you on that one.
Yeah. Can you repeat the question again, Melissa?
Sure. No, you know what? That's okay. We'll move on from it. It was related to once the grant is awarded, the period of time you have to draw it down. And they just were curious about that.
That's the 90 days that,
right.
And you don't have to draw it all down. You just have to draw something down within 90 days to basically say that you are accepting those funds.
Perfect. That's exactly what the question was.
Good.
Thank you, Tammy. Excellent, excellent. Okay, quickly, anything else? We've talked a lot about one major program for single audits, right? So the Higher Education Emergency Relief Fund and the allowability on that. And like I said, we'll get back to some questions and we'll try and circle back at the end of the call to go through some of these. But there's a couple other updates in different areas for higher education we wanted to make sure we touched on for this call. I know that we've seen little glimpses of the compliance supplement or what we think is going to be in it. Matt Dinsdale, any updates from that if you're a higher education institution you should know at this point?
Yeah, I don't think anything's been released in draft form yet, and in regards to that new supplement. I believe we should continue to use the rules we know right now and expect that. And then, of course, once those the supplement has been updated, there will be an alert that goes out regarding that.
But my understanding was that there is a 6-month extension, correct?
Oh, I'm sorry. Yes. Okay. So there was, my apologies. There was a memo released late last week. And the memo, it's M2120, and this is actually very welcome news to probably a lot of people, that has allowed a 6-month extension. And a caveat to that is the memo itself is a direct memo from the Office of Management Budget at the White House to the federal department. So it's not a memo to recipients of federal awards. It directs those departments to allow a 6-month extension. And under that 6-month extension, it's not connected in really any way how it's written, and not connected in any way to COVID or anything like that. It basically states that anyone that has not yet submitted their audit to the Federal Audit Clearinghouse has a 6-month extension automatically. And so we're looking for some communication from the departments in the Department of Ed on whether or not they are adopting that 6-month extension automatically to all recipients of federal awards.
Okay.
And just to add to that, the benefit there would be if you completed your audit past the traditional 9-month deadline within that 6-month window, you'd still be eligible as a low-risk auditee status, assuming that you don't have other criteria that would change that conclusion. I think that's welcome news, again, for a number of organizations that are still wrapping up their either 2020 fiscal year in audits or have maybe some challenges for their 2021s.
Agreed, especially since a lot of us are still working remotely and trying to get all this done. Perfect. Well, thank you for that. Excellent. I am going to go, Laura. We're going to switch gears a little bit and talk about some upcoming standards. I think for a lot of us, we're up finally for the lease standard. Laura, you want to talk a little bit about what, if I'm an institution of higher education, and I know the lease standards goes GASB, FASB, a little bit different deadlines for each, and if you're private, public. But what do I need to be doing right now, thinking about to get ready? Any tips to give the folks on this call?
Absolutely. If you haven't already started inventorying your leases, you need to get started. That's going to help you drive a couple of things. How much time are you going to need in order to get the adjustment that's necessary, or perhaps it's an immaterial adjustment, but you need to get started. One of the things that a couple of our clients who decided to implement early was they went through their general ledger and found accounts where lease payments might be hidden. And so remember just what the definition of a lease is. It is a contract that conveys the right to control an identified asset, so something very specific, a building, a specific car, some other type of equipment. The second thing is for a period of time, and then you have some exchange of consideration. So go through your GL, find the accounts where those things are hidden. Also reach out to others on campus that might be responsible for signing these types of agreements, whether it's department heads. Sometimes your more significant leases might go through your in-house counsel, reaching out to them to see if they're aware of anything, and then start accumulating this information. You're going to need to know the term of the lease and whether or not there are extensions, the amount of payments that are going to be made over that period of time. And then you'll take that information, the cash outflow, and bring it back, discount it back, right? And so the big adjustment will be putting a right to use of an asset on your balance sheet and some type of liability. It's also worth looking at some of the disclosures that are out there. There are a number of really great examples, so it's always good to think with the end in mind, what's going to show up in the financial statements. A reminder, this standard doesn't apply to a lease that's less than 12 months, so you can do that. Another thing that a couple of institutions are thinking about, think about your capitalization policy. If you've got a large enough one, you probably don't need to put on that copy or lease, because this might fall underneath that, even if it does expand over 12 months. Consider whether or not you're going to use an Excel template to track this information, or there are some other software programs out there that you can use to help you accumulate this information and store it and do your discounting. So if you have any questions, feel free to reach out. We'd love to help you.
And then Laura, great. Thank you so much. Perfect. And I know it kind of snuck up on everybody now that we're in COVID, and I know we got it deferred, but here we are. So great tips on moving that forward. Anything else on the horizon in terms of regulatory updates that this group needs to know from the FASB standpoint, or anything from the AICPA?
Do you know what? The simplification, the fair value simplification standard is also, if you haven't implemented that one early, that one's available to implement. It takes out some disclosures around your level 3s. I can't think of anything else out there on the horizon. I mean, of course, the non-cash contributions, but that's not required to be implemented yet. There's some options to adopt other things early if you want, but I think HEERF funding is really going to take our finance departments and business offices busy this year. So,
yeah, agreed. No, perfect. I think you're dead on, and 100% agree with you on that. All right, Laura, thank you so much for that. Lauren, I'm going to switch back to you and go through some of the PPP. We've got some questions on just timing. What are we seeing on timing on forgiveness and how long it's taking after application and forgiveness? Are you hearing anything on kind of what to expect? I think it's institution by institution, but there was a question on when can I expect it? Any or comments on that?
Yes, well, we know what the standard process should be. The lender has 60 days to review a forgiveness application. Then they can remit their initial assessment to the SBA, who then has 90 days to review and comment on the forgiveness application. So, in theory, it could be up to 5 months after you submit it, and organizations have to submit forgiveness within 10 months of the end of their covered period. So this could extend out a long time, which depending on an organization's goals, may or may not be good. We're getting updated guidance on a monthly basis that might go back and adjust an organization's the way that they complete a forgiveness application. For example, the employee retention tax credit is now available to organizations who received PPP funding, but you can't use the same dollars applied for forgiveness that you would use for the employee retention tax credit. So that being said, some of these applications, if they're not rushing through, you're not the first in line, it's not necessarily a bad thing, but there are a lot of reasons that organizations want to get those applications, get their PPP-1 funding forgiven. I've heard different lenders have different strategies and requirements. Some lenders are holding loan forgiveness for PPP-1 until PPP-2, is that application is completed. Some are requiring the reverse, that you have PPP-1 forgiven before you get PPP-2 funding. So really a lot of this is with the lenders. We do know that the SBA is reviewing all PPP forgiveness applications over $2 million. So those may take longer as they go through and assess an organization's economic necessity. They take a look at the costs that are included in there. But I haven't heard of anything more than that 60-day, 90-day period, but I'm sure it could be out there.
Okay, perfect. And then I think you had some updates. We're expecting some changes on some of the PPP, the deadline, as well as the qualifications for it. Can you talk about those? We expected updates.
Yes. So as of right now, the PPP funding is available until March 31st. So that's in a week, less than a week. And we do know that a couple weeks ago, there were significant changes made to the PPP loans that we're just starting to sort through. So before, PPP-1 was only available to organizations that had less than 500 employees. The recent guidance that we received with the ARPA Act, or ARPA, is that for large nonprofit organizations, if they have large nonprofit organizations that have more than 500 employees may be eligible if they have multiple locations, each with less than 500 employees. So whereas before, if you had any more than 500 employees, you would not be eligible for PPP. For nonprofits now, it's on a location by location basis for PPP-1 funding. That's something that has kind of thrown a lot of organizations into a little bit of a confusion. How do you calculate per location? Do we meet this qualification as a large nonprofit organization? And so a lot of organizations are scrambling with a couple weeks with this deadline of 3/31. Additionally, these large nonprofits are wondering, are we not eligible for PPP-2 funding? How does that interplay? Because PPP-2 funding is available for nonprofits with less than 300 employees. So does that per location apply to PPP-2? We're waiting on a lot of this information, but as of right now, the extension is in the Senate, and it's expected that the extension of the PPP-2 application period is going to occur. So we expect that that'll be happening. So no need to rush right now. All indications, and of course, as with everything, it could change. All indications are that it will be extended.
Great. Perfect. And then on ERTC, so the Employee Retention Tax Credit, There was a couple updates there related to some definitions that came out in an FAQ. So maybe we can go through what a government shutdown and the definition of what they spoke about. And then also, I think there was some expansion of the program, and maybe you can hit on both of those topics.
Yep. As I referred to briefly before, the Consolidated Appropriations Act in December expanded eligibility for the Employee Retention Tax Credit to organizations who also had received PPP funding. That was not permitted before December 2020. So now organizations can go back and take a look at their 2020 tax year and see if they're eligible, if they would qualify for any benefit under Employee Retention Tax Credit, as long as the dollars that they're using for the ERTC are not the same that they used for their PPP loan forgiveness. So that's one change. The CAA also expanded the Employee Retention Tax Credit looking forward to 2021, and that is that it's available. It was available through June 2021. Further, it's been extended now to December 2021. For organizations that have less than 500 employees, they now can claim the Employee Retention Tax Credit for any employee paid to work. As long as you have less than 500 full-time equivalent employees, you can get that benefit just for paying wages to employees who are working. If you have more than 500, it would only be available to organizations who are paying employees to not work. It's also been expanded to include certain government organizations, including government-controlled higher education organizations. So that came out in, I believe it was ARPA, to expand that eligibility to government-controlled higher education organizations and schools of that nature, also hospitals and others. And then there are just so many changes now. I'm trying to think of what the last change was. But yes, it's something that's worthwhile assessing for organizations because that credit, the threshold has changed as well. It's $7,000 per employee per quarter, as long as you meet gross receipts reduction. And the gross receipt reduction is defined based on all of an organization's revenue, contributions, tuition, investment income. That would all be included in that calculation, or government shutdown. The government shutdown has been clarified in recently released frequently asked questions. That was a couple days ago. The IRS Treasury further defined what a government shutdown would be. They clarified that just simply statements by government officials aren't government mandated shutdowns. It would be a shutdown that would impact, and they're stating that the threshold's around 10%. And that's not a hard and fast assessment, but it's around, if it impacts about 10% of your organization's operations, that may meet that qualification for government shutdown. So that could impact a lot of schools who are, might have had, residence halls or other types of hospitality functions that were shut down.
Perfect. Okay. You made a really good point that and persons, I'm going to ask you, I don't know, Lauren, that you're the right person, but you brought it up for PPP and ERTC. I think you make a really good point. There's a number of federal programs out there, right? And so if I'm taking credit for these wages, you need, and Matt weigh in here related to double dipping, right? Maybe you can speak to that. If I've taken these wages for the retention credit, can I then use these wages on other federal programs?
The guidance we have today is that no, you should not be using multiple sources of federal funding to cover the same expenses. So I know that can be challenging to isolate what those costs are, but to the best of your ability, you really should bifurcate just to ensure that you're not recouping funds for the same programs from multiple sources of revenue.
Yeah, perfect.
And
excellent.
Just to quickly add in, I know we had gotten questions. PPP2 funding has a reduction in revenue requirement as well that has come through. If you're getting PPP2, you need to have a reduction in your revenues. And how is that calculated? Does an organization required to include their CARES Act funding from the prior year when they're looking at that revenue reduction calculation? And the answer is yes, it would be revenues from all sources as of right now, including that CARES Act funding that you receive. But the only specific exclusion has been PPP loan forgiveness. If you have PPP loan forgiveness, that would not be included in that calculation.
Perfect. And a couple clarifying and, to the best of our knowledge, and I think these are more practical applications to cover yourself. If I've got HEERF 1, 2, 3 funding coming in and I'm an institution of higher ed and you're the auditor, right, looking at this, would you expect these institutions to create separate accounts and keep these isolated, or can I commingle these funds?
Yeah, I think that's a great question. For CFA reporting, it really would all be grouped together. I mean, you could always make the element to separate them and delineate them to whatever you think makes the most sense for your reporting. I think it's, would be helpful just to ensure that you haven't overspent on any of the grants, or that you haven't applied, either lost revenue or expenses to multiple grants. So having that separate account might be helpful for tracking, but there's definitely no requirement for it to be that way.
Okay. And this came up on the NACUBO call yesterday, and we have a question on this too, but what is my requirement as an institution of higher education to tell the students that I'm giving grants to what they can and can't spend it on? What does the law say I have to do? And in practicality, what would you suggest? So, I guess one of the federal folks or anybody else want to weigh in on that? Might be you again, Parson. Sorry.
It's tricky, right? Really the purpose of this this funding is to support students, and that probably doesn't look different for each student and their circumstances. So probably the less involved you get in making that determination is probably best, in my opinion. But so far, we haven't received any guidance that says they have to use it on a particular purpose. It's really meant to support them and their ability to adapt to the current environment related to COVID. So I don't know if you had more to say, Melissa, in your thoughts.
Well,
I know you listened
to the
webcast.
We just said yesterday, so whether it's in kind of the notice, and somebody mentioned here that people were putting up on whiteboards or blackboards, right? This was what the federal government intended. We as auditors, you as institutions are not required to check what they're spending on. There is no legal requirement to do that. But as a best practice, we heard on the NACUBO call, whether it's the communication that goes with the check, right? Or something you have on campus, or something you have on your website, or to your point, some of those black or whiteboards that are out there, just reminding them that it's
the intention,
intention of that. So that was really the best practice that was recommended specific to that. Okay, perfect. Any idea, anybody on this call, and I think it's like a gamble, there was a question of when do we think the Department of Education is going to put out a FAQ on the American Rescue Plan Act. I think the last few times it's taken, the first time it took almost 2 months. I think the second time it was much sooner. I would hope in the next couple of weeks we get anything, but I don't know if anybody has heard anything different, but that's kind of been the trail of tears and the timing that we've seen on the last couple. Anybody heard anything different? No? Okay. So to be continued. Of course, we'll share as soon as we know with you on that, and when we get those FAQs, as well as some finalized allocations, and that from the Department of Education. We had a couple more just kind of tidbits that we wanted to go through. I think we're all going through, and I'm going to change the subject again, the first time in June 30th, 20, a lot of our schedules of financial responsibility ratios and any lessons learned. I guess, Tammy, I'm going to look to you. that you want to share with this group as they're really thinking about either finishing up their fiscal year in 20, if they've not done so and they're still working through their HEERF audits, or in preparation for 21, kind of some lessons learned. And then I know, Matt, you have one from yesterday, probably a lesson learned that we could share with this group too.
Yeah, those ratios were certainly a big change for all of us, and making sure that that information is in the financial statements You do need to make sure that all the numbers, you can trace those back to either your footnotes or the statements themselves. So make sure that you're double checking that. There are some areas where there very little details that can make a difference. For example, with the expendable net asset calculation, you want to include your debt. It's up to the amount of your net PP&E, and it does include any bond funds that are held with a trustee, and your asset retirement obligations are reduce that amount. So, or the amount of debt that you owe. So keep that in mind. With the viability ratio, that is only debt that you're actually going to repay. So with the viability ratio, it does exclude premiums and discounts, as well as that asset retirement obligation. So there's some really little subtle differences in some of those calculations. NACUBO does have some good guidance that they've put out there. So I really recommend that people read through that guidance very carefully because it does provide some great support.
Great. And then Matt, we had a little bit of a lesson learned as we went through some of this yesterday. You want to just give folks kind of the between the two and the reminder?
Sure. Yeah. When you're actually completing your easy audit submission and trying to drop in numbers, obviously, you want those numbers to be reflective of what is in the footnote, or the schedule that you're attaching to your financial statements. It's not always clear from the buckets that are available in the easy audit how those figures get dropped in. So that's where I would definitely caution you, is making sure that there's not like a duplication. For example, if you have life income funds, I think there's a separate call out for that in the easy audit submission, but then you have a portion of that that's already included in your net assets held in perpetuity, that you're not doubling up on any of those amounts. That would reflect a change in your calculation of your score that would be different from the submission to what's, again, in your schedule attached to your financial statements. And then also, I know every school has a different philosophy in what they report in non-operating. And there's a lot of nuances there to be really careful about any additional gains or expenses, especially what is unrestricted or without donor restriction. Be really careful to those inputs and following, again, what you and your auditors have discussed should be reported in that schedule, so that you're not having any differences in that final report.
Right. Perfect. And the last little kind of notice and nugget that I wanted to make sure that was great. And thank you to everybody. I think we're almost at the top of the hour. One last question or one last clarification. The GAO issued a clarification this last couple of weeks on using the acronym for the Comprehensive Annual Financial Reporting Package. I guess, I was going to ask you, Tammy, about it, but I think I'll just go ahead for the sake of time and just remind folks that we are not to use that abbreviation. I guess it's a derogatory term in other countries. So no, going forward, you shouldn't be using the acronym for that. And that was issued by the GAO. So just a heads up for our GASB reporters on that change in notice. With that, oh, go ahead. Yes, Tammy.
Oh, I was just going to say there, I know GASB's looking at maybe calling it something other than the Comprehensive Annual Financial Report. Just recommending maybe you use annual report instead.
Perfect. Thank you. I appreciate it. Well, that's all the time we have today. There are a number of questions we didn't get through. For those of you that submitted, thank you so much. We are working our way through the list, and whatever we didn't get through today, or we'll get back to you. If you have any other questions for the great panelists that have all of this knowledge in higher education, their contact information is in the slides and the handout, as well as those bios. So you'll see that. As you can see, there's links on here to additional resources and how to follow Moss Adams in our webcast and some of our upcoming information that we put out. This is getting updated on a regular basis. And as soon as we know, we are sharing. I just saw an alert go out just now on the shuttered venues. So stuff coming in and coming out as quick as possible. What we really want to hear from you is feedback on this, as well as ideas for a future town hall. We are putting these together as needed. I think based on the number of questions or unanswered questions, we will probably do another one sooner rather than later, as soon as some of the FAQs come out. But we do appreciate you spending your lunch hour with us today, or the afternoon with us today, and really look forward to our next one. And thank you for your time and attention. Have a great day.